Hello everyone, my name is Kaylee Davis and I will be presenting the following analysis on the long and short-term effects of falling oil prices on the ordinary investor. This is just an overview of what we will be talking about today, including an introduction, initial analysis of falling oil prices, short and long-term effects on the ordinary investors, current state of activity, and future direction and conclusion. The economy and stock markets can be greatly affected by fluctuations in prices of certain commodities used worldwide. Oil is one commodity that is distributed globally, and fluctuations in price can have dramatic effects on certain economies, especially those who rely on high imports or exports of the product. Those with heavy investment in oil production and oil companies can experience significant downturns in light of falling oil prices. However, research regarding changes in prices often focus on the broad viewpoint of economic effects rather than the ordinary investor themselves. So now I'm going to show you a brief video of an interview with Lindsay Congdon, who is an economic research analyst. She will provide a good introduction to the effects low oil prices can have, with her specifically speaking to the UK, who is primarily an oil exporter like Canada.
2015 is one of the big uncertainties at the moment. We obviously had the large fall in the oil price in the second half of 2014, and the outlook for this year is very much dependent on supply and demand and where the price finds its equilibrium. Supply is a key factor. It was one of the main reasons for the price fall last year, higher levels of supply. So we think we need to keep an eye on production levels, particularly of the big oil producers like Saudi Arabia. The oil price obviously has a big impact on the UK consumer. The UK is a net importer of oil, so it means that the consumer will benefit from the lower price. It leaves the consumer with more money to spend, so it acts as a tax cut, so more money to spend on other things other than petrol and energy. And after a few years of high inflation in these areas, it will be welcomed by the UK consumer. We also need to remember that the UK is a large exporter of oil, and it's estimated that there are about 440,000 people employed in the sector, 45% of which are based in Scotland. So we could see some regional negativities from the lower oil price. And in terms of companies as well, the oil price has obviously impacted the large oil and gas companies quite heavily in the last 6 months. So from an investing point of view, I think it's important to kind of look through that and really look at the long-term investability of these companies.
The world has viewed dramatic rises in crude oil prices, including a peak value of $145 per barrel in 2008. However, recent years have viewed fluctuating prices with oil values dropping throughout the last several years. As seen in the graph, there has been a significant drop during 2014, with the lowest periods of oil prices reflected at the end of 2015. The fall in prices has partially been attributed to new drilling and fracturing technology, creating faster production times at lower prices than originally anticipated. As this has enabled the U.S. oil industry as a whole to produce 4 million more barrels of crude oil every day than it did in 2008, closing the gap between U.S. oil production and the world's other two top producing countries, which include Russia and Saudi Arabia. Companies who are involved in exporting oil will suffer from low prices, whereas those who primarily import oil will gain from the decrease in price. In response, companies have heavily reined in their spending plans. As well as canceling new developments and slashing capital budgets, they have been cutting their wage bills. For example, almost 40,000 jobs were lost in Alberta oil patches in 2016 due to the significant drop in oil prices and subsequent need to cut budgets. However, the ordinary investor can be affected quite differently from the overall economy or business owner. Those who are invested in oil stocks themselves or other stocks altogether may be affected by falling oil prices as well. The key issues for an ordinary investor can exist in market volatility, return on investment, dividend growth, and price-earnings ratio. Investors should use dividend growth and valuation models to determine present and future values of stock, to identify growth and potential returns that can be gained. The following short and long-term effects will highlight how falling oil prices will affect some of these factors. Falling oil prices can significantly reduce private investment in industry growth as the reliance on oil imports increases. As the profit margin on oil prices dwindle, private investors no longer view oil as a highly desirable investment. As a result, those who are invested in oil stocks may experience a decrease in their return on investment or dividend payments. Falling oil prices can also create uncertainty for investors in the market, whether it be an anticipated rise of prices following the drop or the overall effects it will have on the economy depending on the import or export position. This can either cause the ordinary investor to lose faith in their stock choices and sell, or to further invest while prices are low in anticipation of a subsequent boom in prices. The speculative shock begins to play a relevant role as a driver of oil price increases, as was seen in 2004, when significant index investments started to flow into the commodities market, which contributed to 15% to oil price increases. Although an ordinary investor may be invested in non-energy commodities, changes in oil prices could still have an effect. One study's results showed that concurrent with the rapid growth of index investment in commodity markets, prices of non-energy commodities have become increasingly correlated with oil prices. One theory for the same movement of oil prices and stocks is attributed to a reaction both are making. One analyst believes softening of global aggregate demand could be the reason behind both falling stock and oil prices. Ordinary investors are generally oil consumers as well, and falling oil prices can create more disposable income. This can allow for more income for further investment in the stock market or other areas consumers may choose. If the country is an oil exporter like Canada, a decrease in oil prices can slow economic growth due to decreased profits and potential job loss. This may decrease value in the stock market for an investor, as stocks are usually bid up only in fast-growing markets. Overall, the decrease in oil prices can have a significant effect on the Canadian stock market. Amid the loss of jobs in 2016, Canada's large banks felt a blow to their shares as uncertainty rose regarding the oil areas in a stagnant economy. The effects are described as the collapse in oil and other commodities weighed heavily on the Canadian stock market, which fell 20% from mid-2014 to 2016. If a decrease in oil prices continues for longer periods of time, this will cause consumers and businesses to rely more on oil at the expense of other alternatives. The increased dependency on oil could ultimately affect the stock value of these alternate energy sources, such as natural gas or coal. However, it usually takes time for oil to significantly gain market share, reflecting the long-term trend due to low oil prices. This can create shocks in demand for oil, and as a result, ordinary investors who maintain stocks in these alternate fuel sources may suffer in the long run due to the increased market share for oil at the expense of substitutes. Those countries who import oil will become more reliant on imports rather than exports. A long-term dependence on imports can affect both economic security and stability. Many analysts argue that there are social and economic costs associated with oil imports that are not represented in the price of these imports. Others argue that consuming countries may be forced to alter their positions on certain issues and make political compromises under pressure from oil-producing countries. Although Canada is primarily an oil-producing country, ordinary investors in oil-consuming countries may begin to engage in risk-aversion behaviors regarding the stock market due to the increased economic and political uncertainty. Uncertainty can also exist in the long-term market effects, as output growth is affected by oil price volatility. The adverse impacts on output and the macroeconomy due to oil price volatility implicitly suggest further flow-on effects on stock markets and heavily depend on industrial investment and output growth. Optimizing firms may choose to delay investments due to uncertain energy costs, which ultimately increases stock market uncertainty due to decreased aggregate output. Return on investments would suffer for the ordinary investor as stocks are sold or devalued in an uncertain market. Recently, crude oil prices have experienced an increase to approximately $48 to $49 per barrel. As we can see in the graph, which reflects the last week's trends of crude oil prices, the lows hit to around $47 per barrel, whereas the highs hit around $50 per barrel. Although this is quite low in comparison to the peaks of 2008, this still reflects an increase from previous levels this year. The rise in prices has been attributed to the statement made by the International Energy Agency that said global surplus was beginning to dwindle. This reaction occurred despite the increase in stocks reflected by U.S. data due to Hurricane Harvey effects. However, further increases in price may be inhibited, as one article describes that a sharp rebound in U.S. oil production compared with last week has limited gains in crude oil prices as concerns grow that oil output is recovering faster than refining capacity coming online. Analysts anticipate a balance will occur as U.S. oil production increases, but a decreased demand occurs due to hurricane aftermath. Analysts are predicting 2018 will experience a higher demand while production will slow, creating uncertainty regarding price and all combined with a tighter global market. All of this information leaves investors questioning the future state of the market. One analyst believes it would be foolish to plan for the long term based on current market conditions. Future decreases in oil prices could result in the trend of decreases on other stocks, resulting in lower returns and overall growth. The current rise in oil prices is good for Canada as it enables higher profits and can stimulate economic growth. If this trend continues, investors may begin to bid up stocks in response to the improved oil prices and economy. In the face of uncertain future oil price trends, one analyst provides an important recommendation for investors by advising that no matter what happens to oil prices, investors need to focus on low-cost oil producers. Companies such as EOG Resources, Apache Corporation, and Noble Energy have the cost structures to profit in the face of uncertainty. A thorough amount of research has also been conducted addressing the link between the stock market and oil prices. One study went on to investigate the effect of oil prices on stock returns in Canada, Japan, the UK, and US, and established a link through changes in cash flows on stock prices. However, other countries such as France, Mexico, and the Philippines have revealed a nonlinear relationship between stock markets and oil prices. The conflicting nature of literature reflects the need for investors to understand the type of stock they are investing in, the potential impact oil prices can have on it, and the changes that could occur in their country of origin. Investors should also remain up to date on current knowledge of oil advancements concerning technology and efficiency. This can help investors to identify which oil companies will be the most profitable, especially in the instance of decreasing oil prices. If supply of oil experiences a surplus for any extended period, keeping oil prices low, companies will need to discover how to be sustainable long term with the use of technology. This can affect their overall market share and stock value, so it must be monitored by investors closely to ensure the stock valuation and growth opportunity remains high. For those investors involved in alternate energy sources, decreased value share could occur due to the increased reliance on oil during low price periods. Improvements in technology and efficiency will be important for these alternate energy organizations as they must find ways to combat their depleted share and market value. Investors involved in both oil stocks and alternate energy source stocks will need to monitor these movements as well as to understand how this will affect their stock value and returns. Fluctuations in oil prices can have significant effects, including for an ordinary investor. Short-term falls in price can result in risk aversion behavior, reduced returns, decreased investment, and extended effects on other commodities. Long-term effects can lead to a reduction in alternate energy sources and increased dependency on oil. Trends for future oil prices are uncertain and will depend on supply and demand. Overall, investors must remain relevant on current trends and stock market knowledge.